Good morning, everyone. Thanks for joining us. Today, I've got a special guest, Nick Christie, who's the co-founder of Syla. He's going to be running today's webinar, which is all things tax, as well as he'll be going through a few things relating to the Docker. So I'm going to hand over the presentation to Nick, and I'll be on standby if he needs any assistance.
Hey, everyone. Yeah, it's really good to be here. And yeah, looking forward to going through a little bit of like crypto tax 101, but also showing you a little bit of a demo as well. Like I really like to go into a bit more practical side of things as well to show you how sort of like capital gains works, talk a little bit about some of the implications of this Docker arrangement, and then also show you a practical demo of Syla as well. Just as a quick disclaimer, so obviously, with anything related around tax, when we talk about tax advice, that's something that's really specific to you. So when we do a general webinar like this, it's more, we're just talking generally, so it's not specific to you. So anything we sort of talk about today, it's not sort of specific tax advice, but I do want to try and answer, some of the questions that have been asked as best as possible. So I'm Nick, I'm co-founder of Syla. So basically I work in tax technology and innovation, responsible for doing a lot of the practical side of how do we actually, codify the tax logic in different software. So I'm going to be sort of talking a little bit about that. And as we go, like if you guys want to like post questions in the Q&A box, there is like 20 minutes at the end where we'll be able to try and answer those questions as best as possible for you as well. So please do that and I'll do my best to answer them. So what is Syla? Syla is Australia's crypto tax software. So this is a software solution that you can use to do your cryptocurrency tax. Basically, all the tax logic is built into it. So you just like import your transaction data. We apply the tax calculations automatically. We do some tax optimization as well to help lower the tax that you'll have to pay. And then you can create a report that you can use over yourself or for your tax agent. So Syla is specifically Australian software, so we don't do it anywhere else in the world. And that's really important to make sure the tax outcomes are done correctly. We will show you this a little bit later, like how the software actually works as well. So Syla is really good for investors as well. So some of the main points is the value. Even if you have up to 10,000 transactions, that's covered by our sort of basic intro plan. So it's only $59 for an annual subscription. All of the tax logic's been purpose-built for Australian tax law. So you know that it has been done correctly. And we also have a proprietary, what we call LTFO, or lowest tax first out method. Basically, this is a special algorithm that's used to help like maximize your tax savings. So what we're going to be talking about today, first of all, we have like, what is crypto tax? So I just want to, for some of you who are already a bit more advanced, it might be sort of rehashing things, but for those who are really like new to it, I'm going to touch on that. Then we're going to go through like how to actually calculate capital gains with some practical but simple examples, so you get a taste of how that's done. Then we're going to talk about a little bit how to actually save on tax as well to optimize for better tax outcomes. We'll review a little bit of this Docker tax treatment. Then we're going to do a practical demo in Syla. And then with the time remaining, any questions that you guys have, please ask them and I'll do my best to answer those. So what is crypto tax? Basically, like if you look at our tax legislation, the main sort of body of tax law is called the Income Tax Assessment Act. It's like 5,500 pages of tax law that you can read through. But what it really like boils down to is if you've found some way to increase your wealth, then our tax law basically ensures that you'll have to pay tax on it in some way. And that also includes your crypto investments. So what is crypto? Basically, it's a CGT asset. So that's the technical term in our tax law. It's very similar to shares. So shares are also a CGT asset. There are differences, of course, but it's like treated in a similar way where we have these capital gains and capital losses. So if you have CGT assets that you've used in an investment activity, So for example, where you've purchased cryptocurrency and you had some expectation that that would increase in value, then that's like an investment purpose that you've undertaken. Then this is going to be subject to what's called capital gains tax. So this is where it comes in with those things that you hear: capital gains, capital losses, and there's also a special exemption called the CGT discount. So if you've held a CGT asset for a period that's over 12 months, then you'll be eligible to apply this. So for individuals, that's a 50% CGT discount. If you're a self-managed super fund, then that's a 1/3 discount. So this is a really good tax incentive that you can apply if eligible, where you can receive this CGT discount. So you only have to declare your capital gains when it's actually what's called a CGT event. So the typical one that you've heard is like when you sell your crypto, right? So anytime you purchased crypto, it went up in value and then you sold it, that's a CGT event. And that's the point in time where you have to calculate the gains or loss, and then you'll have to declare them in that year's tax return. There's also a number of other CGT events that you may not be thinking about. Things like whenever you've swapped crypto to another cryptocurrency, or if you've gifted the crypto to somebody else, or even when you pay fees that are taken in cryptocurrency, these are all CGT events as well. So whenever those events occur, you also have to calculate the gain or loss, and you'll need to declare that. The general rule of thumb is whenever you sort of like had this investment, so whenever you had like this crypto asset and now you no longer have it, you've changed ownership of the asset, and that's when a CGT event is basically will have happened. And at that point in time, that's when you'll have to calculate this gain or loss and declare it. So we're going to go through some practical examples now. So we sort of got the basics of how capital gains sort of works, right? But now I want you to show you some examples of how it actually gets calculated. So here's like a really simple example. This is like the buy and hold. So you can imagine that you set up your digital surge account, you deposited $10,000 Australian into the exchange, and then you use that Australian dollars and you purchase just one Bitcoin. Obviously, the numbers are sort of made up for these examples just to make them nice and clean and simple so that you can follow. But you can sort of imagine something like this happening, right? So you took the $10,000 cash, you bought one Bitcoin, and now what we say is that that one Bitcoin that you purchased has what's called a cost base, and the cost base is the amount that you paid for it. So in this case, that's 10,000 Australian dollars. Then imagine you don't do anything else for the entire year, right? And it comes to 30th of June and the end of financial year, and there hasn't been any actual disposals yet. So now you have this one Bitcoin sitting there in your portfolio, and it may have gone up in value, right? So in this example, the market value is now 50,000. So you purchased the Bitcoin for 10,000, and now it's gone up in value for 50,000. But in this example, there's been no CGT event. You haven't sold it yet. So there actually is no capital gain, and there's no assessable income that you have to declare yet. You only have to declare this when you actually sell it. Another really important thing is that there hasn't been any swaps. So you haven't like swapped this Bitcoin for another asset or anything like that. So if all you do is buy and hold, there's no gain that you have to declare. The next example is if you buy and sell, right? This is the next like more complicated example. So it works exactly the same. You can imagine that you deposited $10,000. You took the 10,000 to purchase that one Bitcoin. And then later in the year, you now decide to sell the Bitcoin. And in this case, you sell it for $50,000. So it really went up in value, right? And then if you look at your closing portfolio, you now have 50 sort of thousand sitting there. If you look at the tax outcomes, this is how we do the capital gain calculation. So what you do is you take the proceeds from the sale. In this case, it's how much you sold it for, right? So you sold it for 50,000. That's the proceeds from the sale. And then you have that original cost base from when you purchased it. In this case, it's 10,000. So you take the 50,000, subtract the cost base of 10,000, and you get 40,000. This is your capital gain from that sale. And this is the amount that you'll have to declare on your tax return. Also in this example, it's been held for less than 12 months. So it's not eligible for the CGT discount. If it had been held longer than 12 months, then you would be eligible to apply that. So that can also reduce the gain that you actually have to declare at the end of the day. The next example is for how a capital loss works. So very similar example, cash is deposited, then it's purchased, and then you sell it. But this time you sell it for less. So in this example, you purchased for 10,000, but now when you've sold it for 1,000. So you have $1,000 sitting at the end of the day, and then you have to work out what the capital loss is. So once again, you take the proceeds, which is 1,000, subtract the cost base of 10,000. And because it's now a negative number, you know that this is going to be a capital loss. So this is something that you also declare on your tax return. What you normally do with a capital loss is you use it to apply against any other capital gains that you have. If you don't have any other capital gains to apply it against, then you can actually carry this forward to future years. So it's really important to claim these losses, even if you can't use them yet. What that means is if you have a capital gain, say in the next financial year, or even in 10 years, or however long it needs to be, you'll get to use that capital loss to reduce your future capital gain, which means that you won't pay as much tax in that year when you get to reduce it. So it's still really valuable to sort of maximize your losses where possible, and definitely important to still sort of claim those and declare them. The next sort of part is what we sort of call like the parcel dilemma. And it's really easy to understand once there's an example shown of how this works. So you can imagine it's the same example again, right? So you took $10,000 and purchased one Bitcoin. But then a little bit later, you took $40,000 and purchased another Bitcoin. So now you have two in total. One you purchased for 10,000 and another one that you purchased for 40,000. And then you decide to sell it. And in this case, you sold it for 50,000. So obviously the market's been going up in this example. And then you get to the end of financial year and you need to like work out what was the actual capital gains calculation from this. So you take the proceeds of 50,000, that's really obvious. But then the question is, which cost base do you use? It's like, which Bitcoin did you sell? Did you sell the one that you purchased for 10,000? Or did you sell the one that you purchased for 40,000? Because it's actually going to make a huge difference to the tax outcomes. If you take the first one and you say that that's the one you sold, then the capital gain is going to be $40,000. And this is what you'll have to declare on your tax return. But if you choose the second one, then the net gain is only going to be $10,000 because it has the higher cost base. So I think obviously for a lot of people would probably prefer to choose the one that's going to have a lower tax outcome for you. And I guess the question is like, how do you choose which one, or which one are you allowed to choose? In Australia, you're actually allowed to, you're freely able to choose and pick anything that you want to. Basically, you're allowed to choose, which parcel that you want to sell. So this is where these common sort of methods, some of them you might have heard about as well. The most popular one is probably this first one called first in, first out. So what that does is it just picks the first parcel that you purchased will always be the one that you choose. It's like an algorithm, like a method to determine which one and how to make that decision. The other pretty common one is called last in, first out. So this is where you would choose the last one that you purchased. This is the one that you would choose to sell. There's another method that's a little bit smarter. It's called highest cost. So this is an attempt to choose like which parcel has the higher cost base. This is the one that you would choose to sell. And then what we've developed at Syla is what we call lowest tax first out. So what we do is we actually look at all the parcels that exist and we sort of simulate it and decide like which one is actually going to give you a lower tax outcome. So when we do that, we're also taking into account things like, is the CGT discount applicable or not? What's the cost that you purchased it at? And anything else that we need to factor in. So you don't have to think about, do I choose this one or that one? You just apply this algorithm and it chooses the one that's always going to give you sort of a better tax outcome at the end of the day. What you find is, this is like quite specific to Australia and is being designed specifically for our tax law to help optimize those opportunities. It's not very common in other jurisdictions around the world because some jurisdictions don't let you choose like this. You may only be allowed to apply first in, first out, for example. So this is a specific opportunity that's available here in Australia. So it's really important to sort of take advantage of this if you can. Here's like a demonstration of how those different algorithms work. So this one is like a little bit more complicated again, right? There's like multiple purchases. You can imagine that first you purchased one Bitcoin for $5,000. Then a little bit later, you purchased one Bitcoin for $20,000. Then a little bit later than that, you buy another one for $25,000, another for $15,000, and then eventually you sell it. So once again, like these numbers aren't exactly real. They've been picked to help demonstrate how it works. But what you can imagine is, with crypto, the market, is going up, it's going down over the course of years. So if you're, buying regularly these parcels of the same asset, you will have all these different purchases that have occurred at different price. So if you've done activity like that, you may actually really benefit from picking the right parcel matching method for yourself. So if you choose first in, first out in this example, it's going to pick that first parcel that you purchased. If you do the calculation, then after you apply the discount, you would have 22,500 gain from this example. If you were to choose last in, first out, then it's going to pick the last parcel that you purchased. In this example, the capital gain is 35,000. So you can see it's different, right? Depending which one you choose. If you pick highest in, first out, then it's going to pick the one that has the highest cost base. So basically you paid the most for this one Bitcoin. So this is the one that you're going to choose. The capital gain is 25,000. But then lowest tax first out is also going to take into account the CGT discount. So it's going to choose this second parcel in this case. And the net result here is 15,000. So, depending if you have these different parcels with different cost base, choosing a different parcel sort of matching algorithm can actually have like a pretty decent impact on what those net gains are. So this can be a really good way to optimize your tax a little bit at the end of the day. So we've talked about capital gains, but there's actually another type of income in our tax law, which is called ordinary income. So what we've seen is that most crypto investors actually have at least one source of ordinary income that they're usually getting. You may not, but we do see that it's quite common now. The place where most people receive this is through like an earn program. So if you've like staked your crypto or put it in like a earn account and you've received these interest or reward payments. So these are a form of ordinary income. When you have ordinary income, you have to calculate the market value and declare it. You might also have some distributions or commission payments or even airdrops that would be declared as ordinary income. There's a great question actually that Thomas has already popped up, which is about this slide as well, which is about deductible expenses. So if there's like fees or costs that you've incurred in managing your investments, and provided it's related to an income producing activity. So if you have an activity that's producing income, ordinary income, then any of the sort of fees or costs that are related to that income producing activity can normally be claimed as a deductible expense. And even if it can't be claimed as a deductible expense, it should usually be able to be capitalized, so into the cost base of the assets or to reduce the proceeds from the sale. So there should be some mechanism for you to claim this, provided it's related to an income producing activity or an investment activity. So on the digital search platform, that would be withdrawal fees and deposit fees. You might have other fees you've incurred, like network fees, for example, that also might fit into that. Very specifically, the brokerage fees. So because they already get capitalized into the cost base of your assets. So when you made the trade, so when you purchased the asset, we capitalize the brokerage fee to increase the cost base. It means you can't claim it twice because it's already getting claimed once. That way, you can't then claim it again as an expense. Okay, so I think there's like a lot of questions around the Docker tax treatment. So I'm going to do my best shot at explaining how some of this works. The Docker is like a very specific tax event. It's sort of unique to like digital search. So the exact conditions of how that happens and how that should be interpreted legally. It means that there is no like exact guidance on how it should be treated yet. I know the team there is like engaged with the ATO to try and go through a like receiving advice process from the ATO that could be provided to everyone on the platform. And that could be a great way to get like that binding advice from the ATO. The other sort of ways are, for example, as an individual, you can also ask the ATO, right? So you can ask them, that could be formalized through a private ruling, and then they have to provide you advice on how that should be treated for tax. The other approach you can take for the Docker is that you can also talk to your tax advisor. So you are, of course, allowed to engage a tax advisor who can help you look at your situation and then make a decision about how that could be treated, right? And the third point is that, you know, our tax system is a self-assessment tax system. So you're also certainly able to look at your own situation. And if you feel confident and you've done your research, then you may be able to interpret that and make a decision yourself on how it should be treated. The next question is always like, well, what if, you know, I get this advice, but maybe the advice is wrong or it changes? So the way it works is that provided you took reasonable care in how you managed your tax affairs, it means you won't incur a penalty for any honest mistakes that you've made. So the ATO will still ask you to pay any shortfall. So if, for example, you treated your transactions and the tax outcomes and you paid less tax than the ATO decided that you should have, then you'll have to pay that difference, right? But provided you took reasonable care in the approach that you took, you won't have any additional penalties on top of that for any honest mistakes that you've made. And then let's say you do lodge your tax return, and then later there is some advice received from the ATO on the specific Docker sort of arrangement and how that should be treated. If that happens, you're allowed to lodge what's called an amendment. So provided that happens within 2 years from when you lodge your tax return, then you'll be able to amend that to, update the outcome. So, that might be to declare more tax or less tax, but you are allowed to do that as well. We sort of talked like, what's the possible tax treatments for the Docker and what's occurred. So it's hard, like we can't tell you exactly like how it should be treated, right? Because actually no one knows yet. But we can look at what's like some conservative approaches to it and some less conservative approach. So probably the most conservative approach to look at what's happened is to say that this Docker adjustment, so where your balance was decreased on the platform, we'd probably say that this could be, for example, a CGT disposal event because you no longer have those assets. And then the proceeds from this sale would be equal to the Australian dollar market value at the time that that adjustment occurred. So it's sort of like you sold the asset, right? Like you would normally sell it. So that would result in either a gain or a loss, depending on what the original cost base of the asset was and what the market value at the time of the adjustment was. And this is a default tax treatment like that gets applied when you import your transactions into Syla. So we sort of pre-classify it like this. It's not advice on how it should be treated because once again, we don't know exactly how it should be, but it is a conservative approach that you could look at applying. There's also like a less conservative approach, but the ATO may look at this and say that it's not reasonable. We just don't know yet. And that would be to say that the Docker adjustment is also still a CGT disposal event, but the proceeds from the sale are zero. Basically, you're writing off those assets to say that they're completely gone and you got nothing in return for them. If you were to apply this, which you can also apply in Syla by reclassifying it, it would actually result in a capital loss, and the capital loss would be equal to whatever the original cost base that you purchased those assets for. So, if you talk to your advisor, they might be able to like go through these sort of options, or there might be something else as well, like how you should sort of treat it, and maybe sort of decide like which one. The other option, of course, is just to sort of wait a little bit longer. So if you're still not sure what to do, it is okay to wait. So there is no requirement to sort of get up to date and lodge immediately. The normal deadline for your tax is the 31st October. So what we're talking about, like the financial year that's just finished. So the deadline is 31st October 2023. If you're lodging through a tax agent, you have an extended deadline that goes out to the 15th of May in 2024. So in the next year. And if you don't have a tax agent, but you still want to receive that extended deadline, you are able to call up the ATO and request an extension yourself as well. So I'm sure if you sort of explain the situation, how you're still waiting for this advice to be received about this arrangement so that you can prepare and lodge your tax correctly, I think there's a pretty high chance that they would like provide that extension to you so that you do have time to manage your tax affairs correctly. Cool. So I'm going to show you a little bit about the actual demo of how Syla works, like how you would import the transactions. So in Digital Surge, we support two ways to get your data from Digital Surge platform into Syla. One is by an API sync, and the other is by a CSV file import. So our integration has been custom made we look at all the different types of transactions that occur so that when they flow into our software, it's all classified correctly and everything balances up, which is really sort of good. Cool. So I'm going to show you this now as well. Let me just get this set up. And if you have any questions, I am going to try and address them. After the demo, there is some time for us to do that Q&A. Right. So this is Syla. This is what the software looks like sort of when you first log in. So the way it works is Syla is basically like an accounting or tax software, but it's very specific to cryptocurrency. So we support digital currency exchanges like Digital Surge so that we can import those transactions and we'll help you to apply the tax calculations. So the way that it works is that you sort of come up here, you click Add Data Source, and then you can go through here and pick your exchange. So in this case, I would search for Digital Surge because that's obviously where you've been trading. You pick this, and then we have instructions available on how to do the import. So for Digital Surge, two different methods are supported. One is the API sync, and the other is a CSV file import. And I'm going to show you both ways of how you would generate those on the Digital Surge platform. But we also have all those instructions here as well. So if you prefer to do like an export of your files in a transaction history, you can do that here. Or if you'd rather do like the read-only API sync, you can follow these instructions to do that. So I'm just going to switch over now to my Digital Surge account. I'm just going to check that you guys can see this as well. Might just set this up again just to make sure. Cool. So the way that you do this sync is you have to log into your Digital Surge account. And if you go up into the settings, I'll show you how to do the CSV file export first. So you can go here to the transaction history. And here you can see like all the history of your different transactions that have occurred on your account. And if you come up here to the export history, there's a few different options. The one that we support in Digital Surge is the transaction history. So this basically contains everything that's happened on your account. It's a really good format for that. So if you come here, you then choose your from date and your to date. So if you are doing, if you do prefer to do the CSV file, when you do it, you have to make sure that you pick a date range that includes all the transactions that have happened on your account from day one up to the present date. That's because the CGT calculations depend on what's happened in the past. So it's actually really important that we get all the transactions that have happened on your account to make sure the calculations are done correctly. So the way that
Nick, just to jump in on that, if you leave the date filters empty, it will export all the transactions by default, just as a quick little tip.
Oh, wow. Okay, that's a really good tip, Josh. Yeah, because I was going to show a more painful way to do that, but that's fantastic. Yeah, so Josh has just advised you actually don't have to select this. It's going to do it automatically for you. So just leave these blank, but it is important that you change this from Excel to CSV because that's the format that we accept in Syla. So you just click export. That will export that CSV file. And then if I go back to Syla now, Josh, you're still able to see my screen, right? The Syla account.
Yeah, that looks good.
Okay, perfect. So if you were doing the CSV file import, you would click on the file import tab, and then you would just select that file and upload it. The one I'm going to show you though is the API. So we would normally recommend to do the API key because it's just a little bit more reliable to make sure that nothing goes wrong. And it means you only have to set it up once. So if you need to sync your data in the future, you can just click resync and we'll pull all the transactions in. So you don't have to go through this process again. So the way the API keys work is you go up here, you click API key, and then you come to this dashboard. I've already got one set up, but I'm going to show you how to add another one. So you click add API key, and this is probably the most important screen because it's where you set the permissions for the API key. So this is where you're telling us how much access you want to give to your account. So it's really important that you have this read-only clicked, because this means that we only have access to read the transaction history that's happened on your account. If you were to click the read and write, then it means you would actually be generating API keys that let us place trades on your account, for example. So this is like a security risk. It's useful for some use cases if you want to trade like programmatically, for example, but it's definitely not needed for tax software. And we definitely don't request this from you. And it's really important that you do make sure that this read only is selected. It is selected by default, which is really good. So even if you don't do anything right, it's going to be set up correctly. And if you do accidentally give us keys that have too much permission, we'll actually check those. So if you give us elevated permissions that we don't need, we'll actually reject the key because we don't want you to have that sort of security issue, right? So provided you only give us the read only, it's perfectly safe to do. So you just make sure this is selected, click next, and I'm going to do this. I just have to get my two-factor code. So I would type that in, and then this is your API key. So this is like basically a password that we can use to request your transaction history from your account on Digital Surge. So you just copy this, click finished, then you go back to Syla. You would be on this tab to do the sync. You just paste the key in and then click secure sync. So the transactions will come in, there shouldn't be any issues, and then you'll see the transactions come in on Syla. So if you click here, for example, you can see the different balances. Here I have like 18 SUI. If I go to the dashboard, you can hear here, like it's the same balance, right? So that means we've successfully imported all those transactions. You can be confident that everything is there in the account. Cool. What I'm going to do now is just like switch to an example that's a bit more comprehensive. So there's only 24 transactions on this account. I'm just going to quickly sign out and then log into another account. So I've already imported this one before because it has quite a lot of transactions on it. It does take a little bit longer to sync, so that's why I've already set it up. But you can see here on the data sources, there's like 3,500 transactions. If you load this up, it's like full of all these different sort of assets that we've been able to import. We do like all the valuations for these. If you go to the dashboard, you can see like an overview of everything. If you do have sort of other platforms or wallets, that would also come in here, right? So if you have other data sources that you need to add, you can. If you go to the transactions page, this is where you can see all those individual transactions that have happened on your account. So they all come in here. If you click on them, it will give you more details about what's happened as well. So here, there's like a trade where CSPR has been traded for Doge. There's also been this brokerage fee that's been incurred. Syla does all the market valuations for these. So even though there's no AUD reference, like we're still always able to pick that up. And then we do the tax calculations as well. So, you know, what are the results of these sort of transactions? In this case, small capital losses occurred. So we work all that out. When you're happy with everything that's in your account, you can go to the tax reports page. And this is where you can select sort of which financial year you want to generate a tax report for. In Syla, when you sign up for a subscription, you have access to all your financial years. So even if you have multiple years that you need to do, you'll be able to generate that report for all of them. You do get like this summary here, but what you need, this is just to give you an idea of what's been happening. What you really need is the final sort of tax report. So this is the PDF. You can download that. And this account's a bit bigger, so it might take a while to generate. But the tax report is like gives you the full summary of everything that's happened. So you'll be able to take the final values from that report and use that to complete your tax return. Or you can take that report and give it to your tax agent, and they'll be able to use that to complete your tax return. So here's the report. I'm not going to go through it in detail because it is really comprehensive, but I'll get to sort of the main section. So here's like the tax summary. Here you can see all the little, you know, every sale or swap or anything that's occurred that's created like a capital gain or loss gets summarized here. And then we work out what that sort of net outcome is. So this is like where you would take this value, put it in your tax return, and then you can declare. If there is any other sorts of income or expenses, they show up here in the report as well. So it's really convenient to do that. All right. I will show you as well the two alternative Docker treatments, so you understand how you could apply that in Syla, depending which one, or if you want to do it a different way. So there is existing transactions here. I think I might just swap accounts again because it's a little bit easier to find them in my other one. Cool. So I'm just back in my simpler account because I'm just a bit more familiar with where those transactions are. You can see in my trade history, here is where the Docker adjustments have occurred. So this is where I had a balance of SOL, and now it's been decreased. The way that Syla will by default classify this is to say it's a disposal at market value. So that was that more conservative option that we showed. If you want to change the classification for any transaction in Syla, you can. So you can click on the transaction, and then up in the top right, there's an edit button where you can change this. And then if you go down to the ledger and click on it, you have all the different options of how you could treat it. So if you wanted, for example, the less conservative option, which is to say it's like a write-off where you've received zero proceeds from the sale, you could change that to this disposal at zero value. Then you just click save, and all the tax outcomes will update for you so that this is now treated correctly. So in this case, you can see that it has like resulted in this capital loss because you've received nothing in return. So whatever the cost base of this asset was, it's going to get applied now. Cool. That's basically it for the demo. So, if you ever run into any issues using the software, you can always reach out to our support as well. So we're happy to assist you to make sure that everything's working correctly. We have really good sort of like a live chat system, so you can easily reach out and ask any questions that you need to.
Nick, can I just ask you a quick question? I see on your account you got a distribution. How is that factored in the Syla software, and does that get offset against the capital loss?
Yeah, so the way that a distribution by default, like the tax treatment in Syla, this would be treated as income. So once again, it depends like on how you decide to treat the Docker adjustments. I think there's also two alternative sort of ways to look at it. Either these distributions might be a form of ordinary income, which is what this classification would do. Alternatively, you might want to say that it's just an acquisition of the asset so that there is no income to declare. In that case, you could edit this. We do have a classification for that. I think that can be achieved at the moment with our chain split classification. So it's like you acquired capital invested. Yeah. So if you were to, example, click edit. So at the moment, like this distribution will have a form of other income. So that's how it would get calculated. The other, I guess, like less conservative look at it would be to say that, hey, I just acquired this asset, but I shouldn't have to declare income on it. I just want to recognize the cost base. Then you would change this and you would change it to capital invested. So the way that this classification works is that now there is no tax outcome, right? There's no income that's being calculated. But what will happen is that it'll say that, hey, this asset, you just received it and it gets the correct cost base at market value. I mean, these distributions are in Australian dollars, right? So actually it just means like you sort of like just get this cash and there's no income that you would have to pay because it's like a return of your capital. Once again, it's like there is no exact like right answer yet on how these different events should be treated until we get that clarification from the ATO. But those are the two ways that you could two different sort of classifications you could do in Syla, depending on which one you think is most appropriate for yourself. And just to go back, so I can, change this back to distribution if you want this to be calculated as ordinary income. All right. I'm going to turn off the screen share for Syla and just go back to the presentation now. So we're sort of like hit the Q&A now. If you would like to use Syla to do your tax, you can sign up. It's free to sign up and create an account. It's also free to import all your data from your Digital Surge account so you can see how it works and sort of just play with it. If you do want to generate one of those reports that you would actually use to lodge your tax return, that's when you do have to pay for a subscription. Once again, even our budget plan, it's $59 for the annual subscription. This covers up to 10,000 transactions, all your data from Digital Surge. I think it would cover the vast majority of people. So you can import that and get it done very affordably. We also have a discount code, DS Tax Save. If you apply that during the checkout process, that will give you a 30% discount as well. And now, any questions? I'm happy to do my best to answer them.
Thanks very much, Nick. I think there's a few questions come through on the Zoom panel.
Okay, nice. Yeah, I see the list. So I'm going to sort of go through them. And then guys, keep adding them if you have anything else. So the first question I have is from Jared. He's just asking, if you use Syla to produce the report, can you use them to do your ATO self-assessments? or do you need to use an accountant? The way we've designed the software is that you can do either. So if you want to use Syla yourself, you certainly can. You just import those transactions and generate the report. And then we've summarized those final numbers as simply as possible so that you could take them and to put them into your tax return yourself. So if you're sort of confident doing that, like if you already do your tax return yourself, you should be fine to also generate a report and use that yourself. But if you do use an accountant, you can also just provide them the report. They shouldn't have to do the calculations again themselves, right? Because all the numbers are already totaled for them. So it's just convenient.
Nick, on that question, I noticed on your website you have some other plans that include what's called an insurance report. Would that could you explain how that works in a little bit more detail?
Yeah, so we have a few other plan tiers as well. So the next tier is our assurance plan. What this does is it gives you a few extra reports as well. So in the budget plan, we have like that final PDF report. It's like a summary, like the totals of your tax outcomes. If you've purchased the assurance plan, we have some additional supporting reports that you can use. For example, one of them gives you the list of all your individual tax outcomes. So every single one, like itemized, exactly what's happens. You can generate that report. So that's really helpful if, for example, you are ever like reviewed by the ATO, or if your accountant really wants to understand exactly how the calculations were done, you can run that report and you can provide that to them. The next tier is our tax saving plan. And that gives you access to our LTFO algorithm. So if you have a larger portfolio in particular, and you do have like a lot of purchases that you've made through the year, then you'll be able to apply that LTFO method, and that can give you sort of like lower and better optimized tax outcomes, which is really important. And then we also have the private wealth plan. So this is specifically for self-managed super funds. So that will make sure that all the tax outcomes are done correctly for self-managed super funds. It also means that if your accountant or yourself uses BGL, you'll be able to sync your data from Syla into the BGL software. If you don't know what BGL is, that's all right. You can sort of talk to your accountant and ask if that's what they use. Cool. The next question is, if I've done my tax in previous years using other tools, can I still use Syla and use the LTFO method? Yeah, you can. So let's say you used a different software product last year and you applied first in, first out. You can still import. So the way we would recommend doing that at the moment is you would still take all your historical data, even for those prior years that you've done, and you just import all of that into Syla anyway. It's just going to be a little bit easier. And then what you can do on our settings page is you can actually select the parcel method for each financial year. So in those historical years that you applied first in, first out, you can still apply that in Syla. And then for the current financial year, you can change it to LTFO. So that means you can still keep your results consistent year to year. There's a question here about, is it safer to use the API integration or the CSV exports? I think they're both perfectly safe, provided you generate the API key with read-only access. It's perfectly safe to do. Syla even has this, like we will actually check as well. So let's say you did accidentally create the wrong key that gives us write access. We'll actually check the permission of the key. And if you gave us too much permission, we'll reject the key and we'll give you a warning. So then you can delete the key and then create the one that you need to. So we do take like that security aspect really carefully. So provided you create the key with read-only access, there's no security issue there. If you're still concerned or you just prefer the CSV files, you can. It just means that you can't keep your data up to date. So if you want to resync your data, during the year or even the next financial year, you just have to do an export every time, right? So the API is more convenient and usually a bit more reliable as well, because it means you can't accidentally not, import all your data correctly. Yeah, so there's a question here from Jay about like can only complete our taxes the best we can. Yeah, that's right. It's like tax actually gets like really complicated. So often there isn't, like this perfect answer. And provided that, you do something reasonable, if you've talked to your tax advisor, for example, you've discussed that with them, and you've come to this conclusion that that's how it should be treated, and that's a reasonable approach that you've taken, then that's basically what's expected of you. The ATO can still review you and say, hey, actually, we think you've underpaid here, so you do need to like pay this difference. If they think you haven't been reasonable or you've purposely tried to avoid paying the correct amount of tax, then that's when they start to apply those penalties, right? But provided you've done the best you can and you have done your research and taken a reasonable approach, then that's sort of acceptable to do. If you do need to do that amendment in the future, then that's right. You are entitled to lodge an amendment. So, you can maybe lodge something conservative to begin with and then do the amendments. Yeah, like those options definitely exist. There's another question. Can I deduct my deposit withdrawal fees from my standard ordinary income or only from income generated from crypto? So if your activity is an investment activity, it means all your crypto activity is like on capital account. So it creates like these capital gains or losses. You can't take like capital losses from an investment activity and apply them against like sources of ordinary income, say your salary or wages. So it's sort of like the two activities are isolated. So capital gains and losses are sort of in one bucket, and that's why you have to like carry forward these losses to future years. You can't like take them and then apply them against your other sources of ordinary income. There's one more question about, are there any recent or upcoming changes in tax laws related to cryptocurrencies that investors should be aware of? I don't think there's like been any material changes about how crypto is being treated at the moment. So sort of, the sort of things we've been discussing for the last 4 or 5 years are still pretty applicable. There are like a number of sort of like reviews that are happening to decide, what are like the issues that are present in the space and is there like a better way to do it. And there is like a lot of like sort of rulings and submissions that are happening to the ATO around some of the more complicated activity. So if, for example, you're really active like in the DeFi space or around NFTs or some of these like new protocols, a lot of like similar issues exist around like how should they be treated, because they're all quite novel as well. They're not something that we can sort of look at like the history for, right, to say, hey, we've actually got something similar to this that's happened in the past, so we know how it should be treated right now. I think we'll start to get like a lot more advice around that as well, which should help like give more certainty for, crypto investors and understanding how, the tax implications work out there. So yeah, I'll definitely stay tuned to the space to understand what's happening.
I think that's all the questions, Nick. Oh, actually, no, we've got one more just popped in.
Okay, awesome. Let me just check it. I made a massive loss in crypto trading in the past year, but made some money trading shares and stocks. So I should be able to come my crypto losses, gains, and it's not right. Yeah, okay. So this is a great question. So it sort of like deals with, like Syla, and what we've been talking about today is very specific to your crypto investments, but that's sort of like just one part of an investment portfolio. So you may also have some share investments that you've been making, or you maybe even have a real estate like investments that you've made, and you might have capital gains that you've generated from those other sort of investments. So if you have capital losses from your crypto activity and you have capital gains, say from your share investments, then what you can do is you can offset the two. So any capital losses, even though they're from crypto, you'll be able to apply it to the capital gains from your shares to reduce them. What Syla will do, it will tell you your breakdown of short-term capital gains, long-term capital gains, and your capital losses. If you have these other sources of capital gains, you also have to add them in. So then you would take, all your short-term gains, offset them as much as possible with your capital losses that are available as a whole. And then whatever is left over, you could apply against your long-term capital gains. And then whatever is left over, you could then discount if you're eligible. And then this is what you would declare. So the calculation is a bit more complicated. Syla's report's not going to tell you exactly how that's done because we don't have knowledge about your other investments. So if you do have those other sources of gains and losses, you have to do that calculation yourself. So when you put everything in your tax return, you just declare the components. And if you're not sure how to do that, I would recommend that you ask your accountant to do it because they'll be able to take, the gains and losses from all the different sources and do the calculation correctly to make sure that's done for you.
Great. Thanks very much, Nick. I really appreciated your time today. It was really insightful to learn about the Syla platform and actually see it live in action. So we'll send out this recording on our socials and put on YouTube and send out our newsletters. If anyone has any questions, I guess they can reach out to you via Syla website or find you on LinkedIn or Twitter.
Yeah, absolutely. Hit us up on our live chat. So if you just sign up or even go to the website, we have the live chat in the corner. You can click that, ask your questions. So we'll definitely help you out as best we can. But yeah, feel free to reach out. And yeah, it's been great to be here today.
Thank you very much.
All right. Thanks, Josh. Thanks, guys.